More guns for Ukraine, talk about fewer guns in the United States, and pinning the tail on the donkey of inflation. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributors Larry Summers of Harvard and Steve Rattner of Willett Advisors take us through another volatile week, caught between the rock of inflation and the hard place of economic downturn.
My top priority, addressing inflation.
Another week, the 13th of war in Ukraine, with no end in sight, but Europe tightening the screws on an embargo of Russian oil.
We decided then to have a ban now on de facto 90% of Russian oil imports to the European Union by the end of the year.
And the United States sending yet more weapons to aid the Ukrainians.
Just this morning, President Biden announced a significant new security assistance package to arm Ukraine with additional capabilities and advanced weaponry, precisely what they need to defend themselves against the ongoing Russian aggression.
It was another sad week of mourning those lost because of gun violence, as legislators in Washington once again took up the question of gun safety.
And these families, my colleagues, don't want thoughts and prayers. They want their elected leaders to respond to their suffering.
But when it comes to the economy and the markets, the week was consumed with concerns about inflation, as President Biden met with Fed Chair Powell and Treasury Secretary Yellen, making it clear that the Fed is in the lead.
My plan is to address inflation. It starts with a simple proposition. Respect the Fed. Respect the Fed's independence.
Even as Secretary Yellen fessed up to underestimating the issue.
I was wrong then about the path that inflation would take.
On Friday, we got the numbers we'd all been waiting for, and the jobs numbers came in stronger than anticipating, adding 390,000 jobs in May, keeping the unemployment rate at 3.6% and showing wages growing at a 5.3% annual rate, which pointed to more Fed tightening and took some of the lift away from the markets, with the S&P and the NASDAQ losing on Friday what they'd gained during the rest of the shortened week, and leaving the S&P 500 down 1.2% for the week, and the NASDAQ down almost 1%, while the 10-year yield reached back toward 3 to end up about 2.93%. To help us make some sense of it all, we welcome now Chris Ailman, CIO of the California State Teachers Retirement System, and Sarah Ketterer, CEO and co-founder of Causeway Capital Management. So, Sarah, thanks so much for being with us. Let's start with you on the equity side of it here. What did we learn this week out of these markets?
Well, markets churn during the week. There seems to be uplifts whenever there's some sense that the Fed will back off, but it's very unlikely. There's so much need to crush inflation now, given what a terrible tax it is, particularly on low-income people.
And on the other side, of the bond side, Chris, what did you take out of the week?
That we're at 2.9 and heading to 3% on that 2-year rate, and the curve is going to be flat. I don't know if it's going to go inverted. I already did that earlier, David. So we've got the signal that a recession is somewhere way out there. But, you know, bonds are going to keep backing up. The Fed is tightening. The facts are the facts. The Fed will tighten throughout 2022.
Well, so we've been told by Chair Powell, Chris, that he has the tools necessary to deal with inflation. Does he?
Not this type of inflation. I mean, his only tool is raising rates. And this is the kind of inflation that doesn't have a direct impact. It's a supply problem. It's crude oil. It's commodities. Eventually, but it does mean that he's going to have to raise them consistently and a whole bunch higher than I think people are anticipating. So rough road ahead. I'm very concerned.
Yeah, I would agree with that. He has to lower demand in order to keep prices under control. And that's going to require, I mean, we've just started, not to mention the shrinkage of the Fed balance sheet. And there, other central banks other than China's are all doing this too. This is a global tightening.
So, Sarah,
well, Sarah, when you say slow demand, that means slow down the economy. If you're owning stocks, where do you hide?
Yeah, well, I don't believe in raising cash, because it's one thing to raise it, another to put it back into the markets at the right time. That's why market timing is so difficult. And our institutional clients and our funds expect us to be fully invested. So the key here is to be diversified and use a lot of risk metrics in order to know just how much volatility you're likely to anticipate, and then attempt with the better companies to be defensive. We just outperform as markets swoon. But these are cycles, and then we'll cycle back up again. At that point in time, we need to be in stocks that would take advantage of the impending recovery. We just haven't gotten to the bottom yet.
Chris, to go back to Sarah's point, you've got to slow the economy. Hook it up with the jobs numbers we got on Friday, because that didn't look like the economy is slowing very much. How much does the economy need to slow? We heard from Bill Dudley, the former Fed president here in New York, and he said that actually we got to go way above 4% on unemployment to get the inflation back down to 2%.
No, you're on the point, David. You got to realize the amount of stimulus that the Fed and Congress kicked into the U.S. economy during the pandemic. And we're still living off of that buzz. I got to tell you that, balance sheets of average consumers are still, their checking accounts and their bank accounts are still cash rich. They're not spending that money. They're saving some of it. But, you've got a strong employment market. You've got 5 million people who think they're wealthy enough to not work. I mean, that's just amazing to me. They've got to come back in the market. That's probably going to mean higher wages to attract them back, which is more inflation. So you're right. The Fed's got to raise rates. We've got a long way to go. That's why I don't think a recession is imminent. But we've got a lot of problems that we have to deal with before we're in a recovery mode.
And David, housing is the most lagging of economic indicators. We should be looking at, not housing, we should be looking, for example, at housing. Employment is lagging, housing, orders, profit, sort of in that order. And it's all coming. That's what's so interesting, that these markets have derated by valuation multiple, but the profit hit hasn't happened yet. That's the other shoe to drop.
Well, what about that? Because you've talked about earnings expectations. Are they coming down the way they should, given where we're headed, Sarah?
Very likely. And again, that gets to the point of, per Chris's question, where do you hide? Well, you obviously want to be in the stocks that will incur the least earnings downgrades. And that's typically those at this point that are more defensive, less economically cyclical. But again, it's critical to be prepared to invest in those that are cyclical when we are at some point at the bottom of economies, and we're not there yet. And that's why it's hard to know exactly where it will be. And the whole point of active management is to start, we use a ranking system, so we know how stocks are from a risk-adjusted return basis. And as the cyclical stocks look more and more attractive, they'll start working their way into the portfolio and into the fund. So it's a gradual process. Right now, defensive, and then over time, over the next several months, probably well into 2023, much more cyclical.
Chris, you said it's not imminent. A recession is not imminent. What do you mean by imminent? What do you think about 2023, 2024?
Yeah, I got to be careful when I use words that are vague on timing. Chair Powell did that on inflation, and it really threw us all for a loop. So I just don't think we're going to see it in the second quarter or the third quarter during the summertime, but I am worried about the fourth quarter next fall because the cash in consumers' accounts, they're going to use it up quick, especially at these inflated prices that people are having to pay. So employment is strong, and as Sarah said, earnings are okay. But listen to what CEOs are saying in their earnings calls. They're very cautious. They can't push this inflation in their base prices onto consumers. They won't buy it. So at some point, we're going to start to see weaker economic numbers and then eventually earnings downturns. And I don't think Wall Street's pricing that in, David. It's not paying attention to just the facts surrounding the market in this point in the economy.
Yeah, I would agree with that. Yeah, there are more earnings downgrades ahead.
But Sarah, on this question of the cash on the balance sheet of the households, they do have a lot, over $2 trillion, I saw reported yet again this week. Chris says it's not going to last that long. How long can that continue through? And do we want it to continue through very long? Because the longer we keep up with inflation, doesn't that mean the harder the Fed's going to have to come down in the markets?
Very likely, yes. The more persistent it is, the more psychologically it becomes embedded in how people operate. And that's the vicious wage price spiral, something we haven't seen for 40 plus years. I mean, it's nobody wants to see this. So that's why the Fed has to move aggressively. This is going to be quite different from the 70s because sure, we have consumers with some money. Maybe they will in turn carry higher savings rates with so much uncertainty out there. We also have banks with just awash in reserves. And the problem with that is that means that they'll continue to lend. That's that velocity of money. Money just keeps circulating in the economy, and which is counter to what the Fed wants, which in turn makes the Fed have to be even more aggressive.
And Chris, we've gone through this entire discussion without talking about Ukraine and what's going on with the war on the ground in Europe, much less what's going on with China. You talk about uncertainties. It goes beyond inflation, it goes beyond the economy.
Yeah, you're going to keep me up at night again, David. There's a long list of risks surrounding this market. It begins with the economy, but geopolitics are huge. And, you know, the whole issue with Ukraine, that's the beginning of inflation. We had inflation from the supply chain shocks, but now it's continued on because of the oil shutdown, as you said, with the lead-in, and now food problems because of the lack of wheat coming out of Ukraine and Russia. You're going to have higher food costs across Europe, and that's going to lead to inflation even in the USA. So there's a litany of problems surrounding this market on the long term as well as in the short term. It's not for the faint of heart at this point.
Okay, Sarah Ketterer of Causeway Capital and Chris Ailman of CalSTRS will be staying with us as we ask them to take all that they've just told us about them and put it to work in the markets. That's next on Wall Street Week on Bloomberg.
Where else but on some dead planet lost in space could have come the evidence of inflation, undiscernible on this planet, that led the starry-eyed Federal Reserve to raise interest rates for the third time since February, and thereby throw another cosmic monkey wrench into the financial markets. The Fed's fascinating, if wacky, theory that the way to bring down long-term rates is to keep on raising short-term rates is ever more clearly not produced by any evidence this side of Neptune.
That, of course, was Louis Rukeyser on Wall Street Week way back in 1994 when inflation seemed like it came from a different planet and he could see no reason for raising rates. Well, now, almost 30 years later, we're not on Neptune anymore and there's plenty of reason to raise rates, which poses the question for investors of what they're to do about it. Sarah Ketterer of Causeway Capital and Chris Ailman of CalSTRS have stayed with us. So, Chris, let me start with you as the bond guy here. We saw the yields really shoot up. They've settled back down now some. They're staying pretty under 3 so far as we can tell. Is this a time to be investing in bonds?
David, I love that clip. Thank you for showing that because I remember that show. I made my wife delay our dinner out on Friday night just so we could watch Lou. My favorite coverage all the time. You know, I'll quote Howard Marks here. If you buy bonds and can hold them to maturity, that's a good, safe investment, and you can get high yield bonds north of 7%, which is a good return. The problem for most of us is we have to mark those to market. And the Fed is going to raise rates consistently because now, unlike 1984, we do have inflation, and the Fed is trying to fight it. So bonds, I think at this point, I would be underweight fixed income. And I would not try to hold a bond because I think yields are going to go higher and higher, which is going to drop those prices lower and lower. This is a time where you need to find good long-term but safe and boring investments. So when I think of Sarah and always buying kind of stocks, what kind of boring stocks are out there?
Oh, I love being associated with boring.
Well, but no, he's asking you what kind of boring stocks are there out there, Sarah? Can you find some for us?
Oh, of course. I have a whole portfolio of them. But what isn't boring is what's done so well this year, energy. I would have had old fruit thrown at me 2 years ago if we talked about oil and gas stocks. And then you have all the other defensives, utilities. The metals have done well, the consumer staples. And what has been a disaster this year to date has been the prior darling, the information technology sector. It's particularly bad outside the US and terrible in the US, second only to consumer discretionary. And they both had their multiples massively contracted. But in that rubble of IT, the information technology sector, there are some fantastically defensive companies. We call them value tech. And again, I got a big yawn for that. But companies like Fiserv, which is one of the, we think, the best financial technology companies, they provide merchant acquiring, bank processing software. They're critical for banks and credit unions to run their transactions. And that means the business is really sticky and the multiples on the stock is quite low. The management's excellent. They made a big acquisition. They're paying off the debt associated with that. It just goes under the radar. But for every one of those transactions, there's a fee. And so it's one of these wonderful, dull businesses, and it generates so much cash. And that's exactly what we're looking for now for clients, are businesses that can just ride through whatever the economic environment is ahead and deliver. And that creates less volatility and some downside protection.
So, Chris, does it sound good to you, boring stocks?
Well, what sounds good to me is steady cash flow, you know, and the kind of stock that Sarah's describing, I would describe also as infrastructure. We do those kinds of investments. So outside of the equity market, when you own a pipeline, or better yet, you own an electricity line, you own a toll road, that steady, consistent cash flow really pays off. And real estate in this kind of a market, I wouldn't be a big buyer of real estate, but if you've got it and you can hold it, then you've got some steady cash flow. So those are the kind of things that help you through this type of a difficult market. All of those levels of uncertainties, not just the Ukraine war, the struggles with China. And I think it's a real challenge when you look around the world to find those kinds of investments. Sarah, you invest in the emerging markets. You know, are there those kind of boring yield opportunities in EM countries?
Not many, because people tend not to go to high risk geographies to get boring. Usually they want growth and they're willing to take some risk to get it. But you mentioned China, Chris, and China's fascinating because China in a way is ahead of the rest of the world in terms of earnings downgrades. We've had COVID arrive later and it created major lockdowns in Shanghai and Beijing, and you have like 50 million people were stuck in their homes, more than that. So all of that has created a real impediment to economic growth, and hence the earnings downgrades. And the stock market was absolutely horrible. So the Chinese companies trading in Hong Kong, the ones trading in the US in ADRs, and the ones trading in A shares on the Chinese mainland exchanges, all of them terrible. And this is a rare opportunity. In China being the largest component of any emerging market index, that just means that the indices have fallen, but there is the potential for significant recovery, because the only central bank globally is engaged, major central bank engaged in stimulus now, not tightening, but stimulus, is China's.
So one thing that certainly was not boring this week was ESG investing. We had some very senior executives lose their job over it. A lot of accusations of greenwashing. Where is ESG investing at this point? Chris, let's start with you. What do you think about ESG? Is it here to stay? Is it really having a tough time of it?
Oh, there's no question it's here to stay. But David, let's get away from the initials. And if I mention to you long-term business risk, everybody and every CEO would absolutely agree. Yes, there's greenwashing, but the question is, and you led in the show with it. On one hand, you have us sending weapons to Ukraine, but then the horrible school shootings. And as a fund that represents teachers, we're offended by the lack of federal follow through on gun control, or at least a better sustainable industry. Their ESG is absolutely a reality, whether it's environmental, social, or governance. And I've been saying for a long time, David, that climate change is real, material, and it's going to massively impact our lives in the next 10 years, not in the next 20, it will in the next 20 actually, but definitely in the next 10. And people have to realize that. So, you know, I think people like Sarah really have to think about what I consider sustainable questions for companies about how they operate today, and are they going to be able to operate into the future?
Chris, it's so much more than that. We've had to prove to our clients that these criteria that, again, as you rightly know, we've been using this, and the active management is all about finding better managed businesses that treat the environment appropriately, that don't abuse their employees, that are governed so that they reward shareholders above all. But we can't have companies in the portfolio that don't perform. So using these ESG criteria to isolate those stocks that are going to outperform their indices, that is the holy grail. That's what everyone's working on now. And that's, we've hired a number of people to do that. We're focused on it, all of our research. But what's different now is it's one thing to investigate and use data and say, all right, these companies are doing a better job. It's another to push them, this active engagement. That's what's different now, is leaning on the management teams and the boards of directors to clean up their act, to become more, for example, environmentally friendly, amongst a whole variety of demands that we're making, because, not because of our values, even though they may be our values, it's because it leads to performance improvement.
Chris. David, I think you hit it on the head when you said greenwashing. CEO words are cheap. Right. They really have to show up by their actions. And I agree with Sarah that engagement, holding CEOs accountable, making it part of their compensation, thinking long-term is absolutely critical.
And we learned this week, you get in trouble by fibbing, I think it's fair to say. Thank you so much to Chris Ailman of CalSTRS and also Sarah Ketterer of Causeway Capital. Coming up, we're going to take a look at what's happening next week in markets around the world. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now for a look at what's coming up next week on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. A barrage of data in the week ahead will probably give further indications that China's recovery will be a struggle. Bloomberg Economics expects a bounce in May credit, but softer consumer and factory gate inflation could leave the door open for further easing. Meanwhile, Australia's central bank is set to raise rates as it tries to rein in inflation and will also be at Asia's biggest defence summit as the IISS Shangri-La dialogue kicks off here in Singapore. Now over to Danny Berger in London. Danny?
Thanks, Juliet. In the coming week in Europe, all eyes turn to the ECB on Thursday, where they have a rate decision. More debate has surrounded whether or not this is a live one. Christine Lagarde has said that it's not until July that they'll start the rate hike cycle. But given that inflation is reaching record levels in the Eurozone, 8.1%, even in Switzerland, which of course has its own separate decision, that is reaching its highest since 2008 as well. So what will the central bank do to combat high inflation as markets move to price in the continued inflationary and demand effects of the war in Ukraine? Now to Romaine Bostick in New York.
Thanks, Danny. The week kicks off with Apple's Worldwide Developers Conference. It's an annual gathering where the company outlines its software strategy for the coming year. Elsewhere, SpaceX, the rocket taxi company controlled by Elon Musk, is scheduled to launch its 25th commercial resupply mission to the International Space Station. And the parent company of Facebook and Instagram changes its stock trading ticker from FB to META, Meta, more than 7 months after Mark Zuckerberg said he was pivoting the company's name and mission into the metaverse. And the week will end with the release of the Consumer Price Index for May. The headline number is expected to show that year-over-year inflation held above 8% for a third straight month. It's a persistent elevation in the prices Americans pay that has gone from being a monetary policy quagmire to a political football reshaping the midterm election season. David?
Thanks to Juliet Sally, Danny Berger, and Romaine Bostick. Coming up, we go through the macroeconomics and the market implications of inflation and how to get it under control with special contributors Larry Summers of Harvard and Steve Rattner of Willett Advisors. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It was another volatile week in the markets, and those jobs numbers out on Friday did not help matters one bit. And JP Morgan CEO Jamie Dimon this week gave us little hope for good news anytime soon.
It's a hurricane. Right now it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And it's you better brace yourself.
To help us put together the mosaic of the economy on the one hand and the markets on the other, we welcome now our special contributors, Larry Summers of Harvard and Steve Rattner of Willett Advisors, which invests the personal and philanthropic assets of Michael Bloomberg, the founder and majority shareholder of our parent company. So welcome to both of you. Larry, let's start with that. Sunny today, like on Friday, the jobs numbers were pretty sunny, a lot of jobs. At the same time, the market sort of saw a storm squall coming in because they didn't like it one bit. What did those jobs numbers tell you about where we are in the economy and particularly managing inflation?
Look, the economy is pretty strong right now. The question is, inflation is way above any concept of target. My view has been that inflation's not going to come down to target levels or close to target levels without introducing some real slack into the economy, which means a period of very high turbulence. Whether that slack's going to come because the Fed's going to have to push interest rates very high, or whether that slack's going to come because of internal forces in the economy, inflation eroding people's incomes and so forth, that's less clear to me. But I don't think there's a path to a low inflation economy without a material period of economic slack. It could happen, but it's not the dominant probability. What we saw today was a lot of strength, and that suggests more need for interest rate hikes, and that's what was discounted into the market.
So, Steve, you're a smart investor, so speak for the smart investors. Should smart investors be actually rooting for weaker jobs numbers than what we saw this week?
Well, just to follow on Larry's point, I think his point is completely correct, but I think if you take the probability of higher interest rates being required given today's job numbers, and obviously that was the market reaction, I think the market is way underpricing the likelihood of future interest rate hikes. It's looking at something like 7 more hikes, and that's probably some fraction of what would be required in order to get inflation down by using higher interest rates. So I don't know what whether Jamie Dimon was referring more to the real economy or more to the markets. But I would be very worried about the markets and somewhat worried about the real economy for the reasons Larry said.
Larry, are we seeing any indications yet of a slowdown in the economy that obviously the Fed has to want if they're going to get their arms around inflation?
We're seeing a little bit of indications that some firms are no longer reporting the kind of huge labor shortages that they were before. We're seeing some indications of inventory buildups, but I think overall the picture is still a very stretched economy. You know, the statistic I like to focus on goes to the labor market, and it's the ratio of vacancies to unemployment. Typically, for every 10 unemployed people, we have 6 or 7 vacancies. Right now, we have 20. The highest we've ever had before was 15. So even if there is some easing up, we've got very, very tight labor markets, and I don't think there's likely to be substantial disinflation while we have very tight labor markets.
Steve, you'll remember that Chair Powell earlier, when we weren't seeing the inflation yet, said if it comes, we've got the tools to deal with it. I wonder whether we do. We talked to Larry Fink this week, actually, and he has his own doubts. This is part of what Larry had to say.
I don't believe the Federal Reserve has the policy or the tools to do much with it right now, and I'm personally not blaming the Federal Reserve for where we are right now. But I believe most of the problems we're living with today are more policy generated and supply generated.
Steve, what he's talking about there in terms of policy generated are things like some of our trade policies, some of our policies on immigration where we're not getting as many workers, indeed energy policy. He's saying that's bigger than just a single fiscal stimulus package. And so that's not something the Fed can deal with. Are we concerned they don't have the tools they need to get the job done?
I would be a little concerned, but for slightly different reasons. I think some of those policy issues are certainly legitimate, but I don't think the question, for example, of immigration is really what's driving our inflationary situation at the moment, or really would make that much of a material difference in any near or medium term scenario. I think, in fairness to those who are on Team Transitory, there are some supply shocks going on in the world. If you look, for example, at the price of chicken and eggs, I just happen to see this, they're both up by more than double digits this year. I don't think people are eating a lot more chicken and eggs or eggs. So I think you have to look for other reasons for some of this stuff. And obviously energy was tight. We can talk more about energy, but Ukraine certainly has exacerbated that. But on the other side of the ledger, I just want to make one comment in relation to what Larry said. You know, for those people who basically look at people like Larry and me and say, you guys keep talking about recession, what recession? There is still more than $2 trillion of excess savings or cash on the sidelines. So Jason Furman has done these numbers, and by his math, even with the lower savings rate that we've seen in the last couple of months, it maybe has brought that $2.5 trillion down by 100 million or something like that. So there's still a huge amount of excess cash. If you saw first quarter bank earnings reports, the CEOs and the CFOs are all talking about how much cash people still have in their bank accounts. So yes, I do see trouble down the road, but I don't think it's right in front of us at this moment. And then one very last point I'd make is that as we talk to companies, there is a transmission mechanism from the Fed through the capital markets to companies going on, where companies, especially growth companies, are bracing themselves for it to be harder to raise capital. And you're starting to see them cut back on expansion plans, on hiring plans, on things like that. I don't think you can find that in the numbers yet, but it's some anecdotal evidence that we've started to see.
So Larry, what about that point specifically? Because I've had some people from Wall Street say, when it comes to really quantitative tightening, which we're seeing for the first time this week, that actually it really depends on where that money is coming out of. It's not clear whether that will slow the economy down or not.
I think that we are seeing some beginnings of the evidence of monetary policy working. I don't really understand Larry Fink's views. It seems to me pretty clear that a substantial part of the inflation we have is related to the fact that we have driven demand to extremely high levels. In 2021, GDP in dollars grew at over 11%. That's a reflection of what was happening with fiscal and monetary policy. When you have growth at 11% in total spending, you're going to have high and rising inflation, and that's what we got. So it is substantially related to what, at least with the benefit of hindsight, were policy errors in 2021. I think it's also important to understand that if your bathtub overflows, there's going to be more flooding some places than there are going to be other places. That doesn't mean that the fundamental cause of the problem isn't an overflow. And we had a fundamental overflow, and it manifested itself more in some parts of the economy, in some sectors than in others, and we call those bottleneck sectors. But in many of the bottleneck sectors, we were producing more at the end of 2021 than we were at the beginning of 2021, which is what shows you that it was kind of a demand shock. I don't think we have the tools to bring this down smoothly. The experience is, as I've said on this show before, that when unemployment's below 4 and inflation's above 4, recession comes within the next 2 years. And my best guess would be that's what we will see this time round. Yes, we have had supply shocks. There's also this idea that if it's a supply shock, we're not supposed to adjust policy. Well, I would disagree with that. If the economy is going to be kept in balance and there's going to be inflation, then if the capacity of the economy to produce has been reduced, we've got to reduce the level of demand. And this is why I always go back to the labor market. because the labor market isn't one specific sector. It's everything from child psychiatrists to workers at McDonald's, where we've allowed demand to exceed supply, creating the wage inflation, which is the basis for much of the inflation that we're seeing. So I think that we're in a quite difficult situation. I don't think we had to be in this situation, and I think the Fed's going to do its very best to navigate a path, but there may not be any path of monetary policy that enables inflation to come down to the 2-3% range, and also keeps the economy growing rapidly. We can agree that that's what we all want, but that doesn't make it something that's feasible.
One thing we certainly learned, I think, this week is that Janet Yellen, your successor as Treasury Secretary, now admits that they kept that tap on too long in the bathtub, to use your analogy. We're going to have much more with Larry Summers of Harvard and Steve Rattner of Willett Advisors. We're going to talk about, among other things, greenwashing, very much in the news this week. This is Wall Street Week on Bloomberg.
I don't want to be the environmental police. I think it's wrong to ask the private sector to tell all the entire society we have to move forward. And I have no problem in doing scope 1 and 2, but we've always said scope 3 is forcing big companies, banks, and asset managers to be the environmental police.
That was Larry Fink of BlackRock talking to us this week about the plight of ESG, or at least the E part of ESG investing, after some senior executives lost their jobs over managing the hot area, at least once hot area of ESG investing. Still with us are Larry Summers of Harvard and Steve Rattner of Willett Advisors. Steve, I want to start with you because we've talked about ESG investing before. I've taken you to say, in principle, sure, particularly on the environmental part of it, climate, absolutely, but there aren't that many opportunities. What are we seeing in ESG investing right now? Because it was very, very hot, and now there's a lot of questioning of it.
I think it's still certainly very hot in certain circles anyway. As you may remember from our conversations, I've always been somewhat skeptical of it as an investment tool. If you want to look at ESG principles as a shareholder because you believe that's what's right for the country, for your company, for yourself, for anybody, you're a shareholder, you're an owner, it's capitalism, you have a right to say, vote, do whatever you think is right. But if you look at it as on the theory that somehow you're going to produce superior investing returns by investing alongside of ESG guidelines or restrictions, or whatever you want to call them, I'm deeply skeptical. I've seen little to no evidence that suggests that that's true. At best, it's kind of a push. At worst, it may be counterproductive. I can give you an anecdote, which is a company like Unilever, which was way out in front on ESG issues. Maybe they got distracted, maybe they didn't, but they way underperformed. Now they've got an activist on their board, and so on. And so I just think you have to separate ESG as something you want to do as a shareholder for something that you think is going to actually make the company more money.
Larry, where is the line between ESG, or let's stick with environmental for the present purpose, because I think it's hard to quantify, at least for me, on the S and the G part, but environmental, where's the line between just ESG investing on the one hand, on the other hand, really being concerned about long-term risks, because there certainly are long-term risks for companies based on the environment and climate?
Look, I think that people should make investments largely on the basis of what the ultimate prospects are. I think the problem comes when people who really have an environmental motivation try to attach an economic motivation and make economic arguments that aren't really very strong. I think there's been a whole movement in the central banking community to start focusing on what they call climate risks as if those were central systemic financial risks. And I don't think the evidence has ever been produced that genuine concern about systemic financial risk of the kind we had in 2008 during the crisis, of the kind that reared its head in the immediate aftermath of COVID, that is something that is likely to come from climate issues seems to me to be a quite remote risk. And I think a lot of the enthusiasm came from people who couldn't legislate things about climate through the front door, and so they want to try to legislate them through the back door through central bank regulatory policies. And I'm not really very enthusiastic about all of that. And more generally, I think some of what little evidence there is of positive returns to environmental investing, I don't think reflects so much that it's a way of picking companies that are going to outperform. It's the fact that this was a growing movement. And so first companies that met certain green tests had a little bit of green investment, and then a lot more green investment poured into them. So their stock prices went up, but it was really driven by the pressure from the investors, market price pressure from the investors, not by anything about the underlying fundamental realities of the company. Well, I think there's also a danger. I think there's a danger in this, which is that I think many in the business community, or at least some in the business community, celebrate these processes of their own making pronouncements of one kind or other and encouraging various kinds of investments. And they think that if they make enough noise in that direction, they can avoid strong public policies. My sense is that this is not going to be resolved without strong public policies. And a lot of this business cheerleading has a bit of a subtle motive to suggest that the problem is being addressed without the need for strong public policies.
So, Steve, just last word to you here. Larry raises an interesting prospect. Is it possible that some of the rush to ESG investing, because we saw a lot of people saying they're outperforming, ESG investing is outperforming the S&P 500. Now it seems to have reversed. Was it a rising tide that is now going out?
Look, I have, as I said, I have not seen a lot of evidence that ESG investing has ever outperformed or is outperforming other ways of investing. I think, as a matter of pure investing theory, you could argue that if you constrain the kinds of investments you're willing to make based on a set of criteria that aren't necessarily directly related to profitability, all things being equal, your returns should be lower. And again, I'm not advocating going out and investing in a lot of companies that are environmentally dangerous or polluting simply because you might be able to make more money. I'm simply saying that you have to be careful about how many different boxes you try to check in the course of investing. But I just want to say one last thing, because I think Larry touched on a really important broad point. I think as a society, we're looking to other institutions, whether it's the Federal Reserve or central banks, or whether it's corporations or what have you, to solve problems that Washington is not willing to take on. And I think we need to push back in the other direction and say it's not the Fed's job to solve every problem. It's not companies' jobs to solve every problem. The executive branch, the legislative branch have to step up and get some stuff done here.
Yeah, I suspect, Larry, you'd agree with that, just briefly.
Yes, absolutely. I think that Steve's making exactly the point that I'm making. I would add that I think some of the motivation for some of the happy talk in the private sector may be to discourage public efforts which they don't want to see. That's why I was kind of glad to see Larry Fink signaling that he thought strong public policies were necessary.
Okay, thank you so much to our special contributors, Larry Summers and Steve Rattner. Coming up, we're going to take a look at the war with China on the big screen. That's coming up next on Wall Street Week on Bloomberg. Yeah. Finally, one more thought. Does the Thucydides trap apply to movies? We have no shortage of conflict these days over whether that massive fiscal stimulus was really necessary.
It is nothing short of preposterous that the central bank is still, as we speak, growing its balance sheet.
The American Rescue Plan played a central role in driving strong growth throughout 2021.
We have conflicts over politics, which Ray Dalio says inflation makes only worse.
We are going to have more conflict. We're going to have more inflation. Inflation causes domestic political conflict.
And goodness knows conflicts over Ukraine, with Europe ramping up the pressure on Russia this week by curtailing oil imports.
We could see a reduction of Russian oil into the EU of 90% by the end of the year,
while Russia retaliates by cutting off natural gas supplies. But in the long run, the biggest conflict of them all is likely to be the contest between the United States and China, as the former seeks to maintain its #1 position in the world, while the latter nips at its heels. The trap that the Kennedy School's Graham Allison warns about in his book on the Thucydides trap.
The first proposition is to recognize that because of structural conditions that are the consequence of a rising China that is actually threatening to displace a ruling U.S., that because of this Thucydidean dynamic, the future will be extremely dangerous.
Thucydides may have been a visionary, but when he was writing his Greek history over 2,000 years ago, even he could not have anticipated that the first skirmishes in the conflict might be fought on the big screen. But that's what we saw this week with the blockbuster opening of Top Gun: Maverick, Tom Cruise's best premiere ever, raking in some $124 million over the Memorial Day weekend, which could have made some good money for China's Tencent. That is, if it hadn't pulled its financing for the project, concerned that the movie's glowing portrayal of the U.S. military might just upset the government in Beijing. Until now, studios didn't want to mess with China as it moves toward becoming the largest movie market in the world, something Disney's former CEO Bob Iger talked about when his first Star Wars movie was premiering.
It's the #2 movie market in the world. It will become the #1 movie market in the world in a few years, sooner than everybody anticipated. That's a huge opportunity that did not exist a few years ago.
But things may just be changing. Could it be a coincidence that in the final cut of Top Gun, there was what appeared to be an edit that cannot make Beijing happy?
In the Top Gun sequel, Maverick is wearing a jacket with the Taiwan flag on the back. There was applause apparently in Taiwan when this was shown at the premiere, but this movie will not be shown in China. Does this highlight growing tensions between China and Taiwan?
So this movie will certainly be an irritation in the mix of all of that.
Irritation indeed. But as Tom Cruise says in the movie, we'll deal with the consequences later.
The end is inevitable, Maverick. Your kind is headed for extinction.
Maybe so, sir. But not today.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.